Hi, I'm Mark Abrams, Head of Trade Finance at TFG. Welcome to this panel session on Trade Finance Talks TV. We're delighted to have this partnership with TXF. We are gathered with a group of global commodity traders to look at the key developments in the agri and soft sector. We're going to look at how traders are adapting to changing consumer demands caused by the global pandemic and hear how they are planning ahead for next year. This is a panel that understands what is happening in various parts of the market, from grains to sugar to coffee. I'm delighted to be joined by Regis Leonhard, Global Head of Treasury and STF at Alvi & Sugar, Philippe Penet, CFO and Treasurer at Socafina, Julio Varela, Head of Finance and Risk at ABRAMS, and Ozan Ozturk, Managing Director at ACROZAN Commodities. Let's start with them from a macroeconomic perspective. What's the impact of halted supply chains, the closing down of the hospitality and entertainment sector, and the economic shock on sugar and coffee supply chains? And how have corporate end buyers changed their buying cycles in relation both to demand and also purchase commitments? Regis, starting with yourself and then moving on to Philippe.
Thank you, Mark, for this question, and let me perhaps just highlight one point towards supply chain, which is actually within the sugar trading sector relatively strong and has been extremely resilient over the past few months, and in some of the key sugar production areas like Brazil, India, and Thailand, for instance, countries which have been among the worst hit by the pandemic and restrictions. Those countries have been, however, quite able to operate with very limited disruptions and hiccups, I would say. Then to your second point related to the closing down of hospitalities and entertainment sector, there is definitely no denying that it has an impact, and it had an impact on the white sugar consumption, but perhaps not at the level we initially expected. And from our own internal ABRAMS proprietary data, we have assessed around 1.6% decrease year on year. We've been fairly surprised by the strong demand for both raw and white sugar, and talking more especially on restaurants, on hotel and catering, which saw this decrease in demand. This has kind of been offset by three trends. The first one, an increased domestic consumption, people eating more at home and stockpiling a bit. Secondly, governments, which actually have also built up some stocks, and I can give you the example of large state sponsoring white sugar imports like in Pakistan, Ethiopia, or China. And thirdly, while 2018, 2019 were kind of surplus years for white sugar, 2020 was much more a deficit year, with a lower crop in the EU, Ukraine, Russia, and Thailand, for instance. Then towards the buyer behaviors. Typically, here we need to distinguish the raw sugar buyers, mainly refiners, and the white sugar buyers on the other side, which are more manufacturers or wholesalers, distributors. On one hand, the refiners enjoy very good market conditions in the sense that they saw their input, being the raw sugar, decrease fairly rapidly and strongly in the wake of the energy prices. So they were quite incentivized to purchase spot, while the white sugar buyers, which traditionally are hand-to-mouth buyers, as we say in our jargon, buying, let's say, 1 or 2 months forward maximum, haven't really changed their behaviors.
And Philippe, on the coffee side, are you seeing a similar trend, or is it very different?
Yes, thank you, Mark, and welcome everybody. Yeah, I mean, I think on the coffee side, some of the demands element that was mentioned by Regis, we did see the same pattern. So yes, the demand has been impacted, but let's not forget that the demand in coffee grew year after year by approximately 1.5 to 2% a year. So the demand will be less strong this year. However, I think what we saw, it was a big shift of consumption from indeed cafe restaurants towards home consumption. So in a way, I think people were expecting a much lower demand, and the reality has been probably half-half. So yes, the demand will have reduced, but not as much as anticipated, because people still drink coffee, in the up and in the down time. So I think coffee remains a beverage which is basically drinking quite a bit even during crisis. So that's a given. I think on the supply chain, what's important is that this is very strong resilience of the supply chain on the coffee side. Why? Because at the end, for many countries, coffee remains a hard currency, so coffee needs to be exported. Supply chain were pretty well protected, I would say, from the COVID. What we did at Sucafina, we put in place on our website a kind of a COVID app to basically be able for our stakeholders to follow all our supply chains and making sure that if impact or delay, they could be seen instantly. So in a way, I think we've seen a pretty resilient coffee sector to the COVID, and I would say yes, demand will be a bit lower, but again, it has kind of shows some quite resilience towards this epidemic so far.
Thank you. And I guess one of the main points is it's all great having the demand, but the issue comes on the financing side. And just from a personal perspective at Trade Finance Global, we've seen huge shifts. Just like everyone, we've seen some of the large banks pull out of the market. And then there was talk of effectively on the fund side of the alternative credit, but then there's been obviously redemptions there as well. I mean, what we've seen, obviously we need something or someone to step up to the plate, and what we've seen is quite interesting, and it'd be interesting from a panel perspective as well, is some of the mid-market banks and lenders stepping up, restructuring some of the facilities, so allowing capacity to free up especially on the prepay or the pre-export side, and also looking at further, I suppose, separate or segregated facilities that kind of appease some of these newer banks that are stepping up. So just more generally, has the pullback in trade finance and the different structures that come within it, so those main banks and extending limits, have you seen that have an impact? And also, so Julio, talking to you, noting, I guess, the slower onboarding and changing in policy that they're also having, what issues are you seeing in the market because of that?
Clearly, these large historical lenders to the commodities sector exiting the sector is a huge concern. At Ameropa, we've been lucky that, and it's pure luck, that we were not exposed to these big exiters, ABN or BNP. But where we had transactional lines in some of the hotspots of the let's say of the difficulties geographically, like in Asia, we have had to somehow review some of the structures and be pragmatic with the lenders to basically give them the necessary comfort. Yeah, so I think part of the solution is towards working better with the lenders to give them the comfort they need, because clearly alternative financing and other sources of financing won't fill the gap. So it is for the banks to actually keep supporting us and us giving them what they need. In terms of KYC compliance, onboarding, indeed. We see processes slower than they were before, but they were already super slow. So it was already impossible to get the KYC done in less than, call it, 2 months or whatever. So we see these onboarding slower, but what we see even slower is the decisions at the banks. So we see that the credit committee, the risk committees of the lenders are super cautious these days, and basically that's where I see things slowing down even more than in the KYC or compliance part of the process.
And I guess talking more to the real impact, because we can talk about restructures and bringing in further facilities and creating new entities, but in relation to the actual suppliers, so Ozan, turning to you, who are the actual net losers of this lack of finance? Have you seen a lack of liquidity have a big impact on those suppliers? And also with the pullback of these standard trade finance banks, where do you think the new liquidity will come from?
Frankly speaking, in my opinion, the biggest and the net losers of the current trend is the small to medium-sized enterprises, because the big multinationals, giant houses always have their alternative resources. They have already the financial capabilities. But if we look at the overall supply chain, the disruption in the access to the finance at the SME level, will in the long term damage the whole supply chain, because these SMEs are the essential parts of the overall flow. And starting from in the last 2 years, you know, as all of the participants mentioned, the due diligences, KYCs, these that, you know, this kind of formalities were already damaging the SME segment. But starting from the new year, followed with the COVID and especially the frauds happening in Asia and Middle East and other places, now with the pullback of the trade finance banks, the traditional big trade finance banks, now the other banks are also following the similar trend, or in the best case, they are now in the pause mode, watch and see mode. The biggest damage is on the SME segment. I can simply say how this gap can be filled in, how this vacuum can be filled in. We have experienced this in the past, especially starting from 2010. Trade finance funds were aggressively penetrating into this segment, filling in the gap of the SME requirements. But unfortunately, in the last 2 years also, that trend is declining. We again expect the trade finance funds to be back into the picture. I don't know when and how, but if you consider the profitability and the gain, SMEs are the segments who are just generating the income to these kind of funds. We might see alternative funds, new structures, or new names filling in this gap. I also have a personal view that, you know, we might see Chinese banks penetrating into trade finance gaps, because today when we talk about any commodity, financing of any commodity, all the flows depends on China. If we might see a strategic level of decision from the Chinese banks, not only to be the major player of the game, but also the major player of the financing this game, I have that expectation also to happen in the near future or in the long future, I don't know, but this gap has to be filled in by someone.
And I guess, you know, when we're looking at the more, we can really segment. So looking at the more vanilla on the receivable side to going down to the structured side. And when we look at this kind of risk off attitude that we've got at the moment, how, I suppose, Philippe, turning to you in terms of yields and appetite on structures like prepays and the ability to secure that longer term financing, how have you seen that? Have you seen that change in the market, and how do you think it's impacting the wider trading side?
Yes, clearly, I think the word caution was mentioned several times by my colleagues. I think the banks are pretty cautious right now. So it takes time. Banks are requiring and small players. So it is there. That's for sure. And we've seen some interesting trends actually with, for instance, the DFIs of this world, the IFCs, the FMOs, the KFWs, willing to join basically some syndicates or willing to help, you know, the player in the market to basically fill the gap left by some of the traditional trade finance banks leading the space. So I think, you know, yes, the pricing will probably increase a little bit. That's a given. But on the other hand, in terms of liquidity, I believe, as mentioned by Ozan, that not only the funds we may see actually one of the Chinese banks in Geneva. So there are alternatives, but clearly for the time being, the banks ask probably additional security and want to make sure that structure are watertight in order to lend to basically commodity traders. Yeah.
And Regis, on your side, I mean, so we've talked about this lack of availability of trade finance and increasing yields. What impact do you see on this having on your market in the near term?
Well, actually, in my opinion, we should kind of be watchful of a dominoes effect, which could occur in near or medium term. Let me just give you the example of the sugarcane mill sector in Brazil, which at the beginning of this calendar year, so before the pandemic, enjoyed quite favorable market conditions, with their domestic currency, the Brazilian real, having worsened a bit against the US dollar, making their export for sugar, mainly US dollar driven, much more attractive at that time. And they kind of seized the opportunity to lock and price their future production forward through derivative hedging, for instance, relying at that time with relatively large and ample liquidity and credit lines, provided first for the large milling operations by banks, and secondly, at that time, for the second and third tier millers by traders themselves. But with the scarcity of liquidity at the moment, in case of sugar price spike, this would mean margin calls to be paid, and those stakeholders might face some real difficulties. And secondly, they could also suffer a kind of a double whammy effect, because when they entered into those kind of derivative hedges, they never budgeted that their credit facilities would be repriced so high. So they could also be penalized, financially speaking, having and seeing their financial performance weakened too.
And then if we actually look at the fundamental supply chain, so Julio, turning to yourself, I suppose for AMEROPA, with a focus on grains and fertilizers, have you seen a change in the volumes that are actually traded, and also the mentality of the farming community, of the suppliers here? And how has, if we look so at that production side, but also logistics, have you seen a further effect there, and what changes are you seeing?
Yeah, so this is it's interesting. When we all went into the first lockdown in March, the banks were very anxious about the COVID and asking, what does this mean for you, and how do you expect it to materialize in your numbers? And at the time we told them, listen, we don't see any reason for the coronavirus to basically affect the fundamentals of our sector, in particular with regards to grains and fertilizer. I appreciate coffee and sugar is slightly different, but in our case, in particular fertilizer, it basically depends on climate, and on the prices of the end product, and we've actually been surprised of how right we were in March when we were telling the banks not to be concerned, because we've seen record volumes this year for AMEROPA, and I can't tell you for the market as a whole, but clearly governments are stockpiling very much. It's very much the case in fertilizer. Recently, we've seen huge volumes of urea going into India. But also privates all around the world are stockpiling, and you see that obviously driven by China, and you see that in the prices of many of the soft commodities that are going up these days. So in our case, we are going to have volumes probably 20% above what we did last year. Some of that might be a flight to quality in terms of whom you want to trade with, or a disappearance of some of the smaller players. But a lot of that is just the consequence of a market that is fully functional. And indeed, we have not seen any kind of disruption in logistics due to COVID. We've seen here and there some ships where the crew has had to go into quarantine in the very early days of COVID, and then you lose 14 days and you pay a bit of demurrage. But other than that, no disruption, and I think that we need to be proud of that, because as I tell our lenders, there are not that many companies in your portfolio, in your broader portfolio, let's say, taking all activity sectors, that can tell you 2020 might be a record year for me. So in that respect, I think that touch wood, but we are on the safe side these days.
And look, and it all comes back to that main point, which is, it's not so heavily talked about, but on the policymaker, governmental side, it is, which is food security, and that's hence the stockpiling. And I guess, Ozan, turning to yourself, on the production side, especially in the Black Sea, and with where crops where they are this year, please could you discuss, I guess, pricing and also what changes there's been, noting the effects of COVID, but also restrictions on Russia and changes in that mentality in the farmers and the suppliers that you're working with?
As the other colleagues mentioned, just I think agribusiness is the best doing one among the commodities since the pandemic started, because people keep on eating, especially the basic products, soft commodities. Other than some changes in the consumption patterns, the overall consumption still remains same. However, when we look at the current scenario, we have to go back to March. In the agri size, mainly from Black Sea region, when the pandemic started, when the lockdown started in March, there had been demands postponed between March to June, which reflected as additional demand at the beginning of the new crop year, starting from July onwards in the Black Sea region. In Black Sea, some products has been produced less than expected this year. For example, there is shortage in corn and oil seeds. But other than that, what we have observed, the government demands, the strategic purchases of the government institutions, and I can simply say nearly doubling, the double of the demand from the food aid organizations. For example, WFP, we are supplying to them and they are buying more and more compared to this year. And postponed demands, government demands, aid organizations, strategic stockpiling, all coincide together. And today we can simply say in any products, we have experienced increments over 20% on the prices starting from July to today. And this 20% is minimum 20%. And we come across an inflated price period. And from the farmer side, especially in Russia, Russia was one of the first countries reacting to the pandemic on the food security concern. In April, in an unexpected way, Russia banned the exports of the oil seeds, for example, or the exports of the processed cereals. And then it was followed by export quotas and volume restrictions in May and June. And because of the increasing prices domestically. And in Russia, food security became the concern and prices increased. And Russian farmers started the new year with a positive psychology that their products are selling higher and they have to sit on the crops. And majority of the products has been in the stocks of the farm gate still. That is why today, this year had been an exceptional year for the start of the new crop harvest campaigns. Extra demand, immediate purchases from the government institutions, less concern on the prices, but more concern on the security to cover the quantity. And today we come to this situation. And now from now on, we are all observing how will be the trend for the remaining of the crop year.
And Philippe, turning to yourself, I mean, looking more holistically in terms of both the supply and demand side, and noting the volatility in the coffee markets, have you seen big variations this year on both sides of the supply chain? And also in terms of traders managing that volatility, and just also would like you, if possible, to touch on, with those large changes in terms of on the trading side, how that like a potential loss of expertise on the trade finance side has impacted that, and do you think will impact?
Thanks, Matt. Yeah, I think, I mean, the COVID time shows that, you know, we had strong volatility in the market, and that's on one hand, you know, traders understand volatility, and this is the risk they're managing. So I think that's been sort of okay. I mean, on the coffee supply chain, but still, you know, we've seen massive variation in terms of prices, plus 40%, and a strong correction at the end of the summer, which basically means that indeed are the lenders of the traders needs to completely understand, you know, how basically our business operates and what sort of financing means we have. You know, it was mentioned earlier on the problematic of the margin calls by Regis. I think it's a very important component. You know, when we lose basically key financiers in the trade finance world, we understand basically how traders basically manage volatility and what are the financing needs associated with this volatility. Then, you know, we on our side are relatively comfortable. When we lose expertise and when we see big trade finance banks leading the space, you know, there is a risk that the credit committee and the risk guys of those teams basically as well leave the space. And then we end up basically as traders facing the credit committees who basically see us more as corporate and do not automatically understand, you know, the risk management associated with our role as traders, which is super important, and the consequences on the financing side and the liquidity. So, you know, I just hope that those guys will basically, you know, and in other houses, and then the expertise will not be lost. But that's something that we probably have to take care of, which means probably on our side to take additional room for additional buffer to ensure that in case of strong price volatility, we can basically cope with, you know, margin calls, repeating margin calls, and other type of situations where, you know, urgent liquidity is needed. So I would say for me, the loss of expertise is an issue. I hope that it will basically not be so big in the long run, but something that we need to watch out, which means that additional, you know, measure on our side to basically protect the liquidity just in case.
And I guess, and turning back to in terms of the demand side, so Julio, you spoke before about stockpiling. In terms of, I mean, we continue to see this kind of focus on sustainability and need to keep food-related supply chains moving. So have you seen any insurer or multilateral support changes, and how's that affected the market?
Yeah, insurers are very cautious these days. And you know, it's become a nightmare to get credit insurance for some of the frontier emerging markets. Also insuring cargo, in particular with the stock management agreements, is becoming very complicated. With regards to sustainability, obviously it is a big concern for everyone, and I think that the industry has a very big role to play in that respect. However, I have the impression that this year, because of the pandemic, the focus is and the frauds that happen in the sector, the focus is less on sustainability, and I would say that the hot topic these days, when you have banks trying to sell you something different or to push you to change the way you work, is rather on the technology side. So we are we are very much incentivized to get familiar to the new tech tools that we have to basically manage risk. Yeah.
Noting the time, I'm just going to open it up to the floor about your predictions for 2021. So it's no surprise to everyone that there's everyone from the insurers on the insurer side that there is a view that there will be an increase in defaults coming to 2021. Be interested to see how you think the trading will change in the market, but also as economies do reopen. Right now, it looks like we're going to a further lockdown, but coming towards the end of the year, early next year, those trade flows, those supply chains will grow. And in terms both on the risk management side, but also on the financing side, it would be interesting just to see where you think we're going to go in 2021. So just a quick one on predictions. So starting with you, Regis, and then moving through.
Yeah, so as highlighted by the rest of the panel, people actually on the planet need to continue to eat. And as such, I think that among the commodity players, the soft one might not be the most impacted for 2021, even if, as you rightfully said, the default might increase in the coming months. In particular on the sugar sector, the fact that this is a basic commodity and an essential good for human food, there's going to be even more scrutiny from the governments and state-owned bodies to secure the supply chain and to make sure that the population will not suffer any disruption.
Thank you. And Ozan, what predictions do you have?
That is the most difficult question of this panel, to predict something for 2021, because everything is unpredictable. What I can say is I am expecting more and more government interventions in the business. It is not only with the direct purchases by the government institutions, but changes in the regulations, import duties, maybe for some countries, free imports or export bans. Because we will, in my opinion, in the starting from 2021, which is the North Hemisphere second part of the crop year, we will see the real situation of the supply demand. The governments will look what they have in hand, especially exporting governments or the importing governments. Then the second era will be different depending on the trend of the pandemic. If we see further lockdowns or quarantine implementations, we might see more aggressive government interventions with the procurements to manage the food security. On the other hand, the key destination countries like India and Turkey, for example, giving us some signals with the changes in the import duty policies. For example, on the protein special crops, we might see India reducing their import duty structures. Turkey already took some steps till end of this year. They reduced the import duties for the basic grain products. We might see upcoming regulations on the edible oil and oilseed products also. Of course, these are having major effects on the supply with additional pressure on the price increments. Or vice versa, if we see the supply chain has been badly affected and destination consumptions are reducing, we might see a downward trend in the prices. That's why it is a little bit complicated scenario. But I think the governments will be the major indicators for the remaining of the current year's crop year.
Thank you. And just in a few words, Philippe and then Julio, just your views on predictions for 2021.
On our side, on the coffee side, I think, yeah, we'll probably still see some volatility, probably not as much as last year. So we hope that we will have, a sector which will still basically grow despite the COVID, and I think we're pretty confident about that. As maybe just one word on the lending side, with liquidity there, I think, the banks needs to basically make sure that they understand the sector and they cannot look at the supply chain without understanding the trading function, which are absolutely fundamental. So I think if they work under the right structure with the right basically players, it's a very not only interesting but profitable sector to be in. And I think it's very important not only that they keep their expertise, but they keep basically financing this segment of the supply chain, because it's absolutely vital and it is a real economy. So I think for me, this is a key message. We're probably lucky around this panel because there is no issue on our side about liquidity, respectively. But still, I think it's very important for the lenders to understand that this segment of the supply chain is just very important for the overall economy. So, I count on the banks and I count on the funds to come into the sector, which for me is very important for the real economy.
Julio?
Yeah, well, listen, I think that the change is the only constant. So the only thing I'm sure for 2021 is that we're going to have a lot of fun, a lot of emotions, and a lot of change. I would expect trade wars, not necessarily the same that we are seeing, new sanctions, sanctions lifted. I'm watching with a bit of concern what's happening between France and Turkey. Never know where that could go, but expect these changes to happen. Climate is changing, and we should definitely expect adverse climate here and there next year somewhere. We had a once in a century drought in Romania this year. Australia is now recovering from 2 years of also exceptional drought, and I would imagine that next year we'll have some adverse climate conditions somewhere. But and agree with all the other panelists on the big trends. But the only thing I'm sure is that we're going to have fun and emotions.
Thank you. We don't have a panel or an audience even to clap, so I just want to thank the panelists. This has been a great session. Thank TXF for bringing this to light today, and hope to see everyone for a drink soon.